So in India, nearly 75% of personal loan are given by the NBFC rather than the traditional banks. Names like Bajaj Finance, Tata Capital, Aditya Birla, and Navi and Home Credit, many more NBFC have become a backbone of the India lending ecosystem. But why? So banks basically generally prefers lending to customer with strong financial and credit score. NBFC on the other hand are serving the real India. They lend to the self-employed individuals, small business owners, first-time borrowers, and many people who may not easily qualify for the bank loans. Since these borrowers carry relatively higher risk, so NBFC basically charge from them typically higher interest rate. Depending on the credit profile, the interest rate between 10 to 30%. And these create an interesting investment opportunities for the investors. When you deposit money in the banks basically take money from you at a 5 to 6% of interest rate, and they give to someone else, a borrower, at about 8 to 9%. So the spread gap is about 2 to 3%, which bank basically earns. NBFC operates differently since they lend at much higher interest rate, so they also willing to borrow money at higher interest rate from institutional investors. So this create an opportunity for the investors to credit market and potentially earn a better returns than traditional fixed income product. However, lending to just one NBFC is very risky. Just like you don't invest your entire money in portfolio in a single stock, you invest in 20 to 30 different stocks. The same way, these AIF also invest your money in different NBFC or different debt structure opportunities. That's why alternative investment funds come into the picture. And AIF pools money from multiple investors like 1,000 crore pool of money, 20,000, 2,000 crore or 5,000 crore, and they deploy that capital across different NBFC credit corporate borrowers and structured debt opportunities. So instead of taking exposure to the one NBFC, they take exposure to the different profiles and helping to reduce the concentration risk. Many private credit AIF aims to generate returns of around 12 to 16% annually, with income often distributed on quarterly basis. That's why this asset class has become interestingly popular among the HNIs and ultra HNI segments, which looking to relatively a higher and good cash flow income. The minimum investment starts from 1 crore, but the good part is you don't have to pay the 1 crore on a single day. You just commit a 1 crore and the fund manager calls the capital in phase manner. Example, 25% initial and the rest over the 18 to 24 months. Private credit is becoming one of the fastest growing asset class globally because it gives investor access to equity like return potential through a diversified debt portfolio. If you like to understand how this asset class works, the risk involved, and whether it is suitable for your portfolio, feel free to reach out to us and we will be happy to explain you in detail.